Hello, everybody. My name is Buitink, and today I'm going to talk to the man who hardly needs an introduction, best-selling author Jim Rickards. I just finished reading his latest book, The New Great Depression, and I'm honored to have him on the show today to talk about this book, his view on the pandemic, economy, and how to preserve your wealth. Hi, Jim. Welcome.
Hi, Paul. How are you? Great to
Yeah,
be
not
with
too
you.
bad. Good to see you again.
Good. Yeah.
So let's start with the new Great Depression. You talk about the new Great Depression. How would you define a Great Depression?
Well, it's a good question, and it's kind of points to the distinction between a depression and a recession, and they're two different things. Recession, people are familiar with, economists use the term all the time, and it has a numeric definition. It's two or more consecutive quarters of declining GDP. There are a couple other factors that go in, but that's the basic rule of thumb. So two consecutive quarters, two or more of declining GDP, that's a recession. And of course, we had a recession, at least in the United States, actually probably most of the world, in the first half of 2020. First quarter and second quarter were both down, and there's the recession. So the third quarter growth was quite strong. It didn't come all the way back compared to what was lost in the first half, but it was strong. And so that you could argue that the recession was over by July of 2020. We have a group in the United States called the National Bureau of Economic Research. It's a private group of economists, but they're the official scorekeepers, if you will, about recessions. They did declare a recession started in the first quarter. They haven't said it's over, but it's very likely that they'll reach that conclusion. A depression is different. Economists, first of all, don't like the word depression because it's more subjective. It's not as quantitative. It involves a lot of almost psychological, behavioral variables, if you will. But depressions are real; they happen, and we're in one now. But economists just don't like to talk about it. They've kind of banned the D word, as I put it, from the vocabulary. So a lot of people assume that if a recession is two quarters or more of declining GDP, and a depression sounds worse, that must be 10 quarters of declining GDP, some really horrible economic outcome. And that's not the definition. You can actually have growth in a depression, but the point is it's depressed growth. It's growth below trend, below potential. And for that matter, I think you could make a good case that we've been in a depression since 2008. You look at the recovery. Okay, we had a recovery from 2009 to 2019. It was the longest expansion in U.S. history, but it was also the weakest expansion in U.S. history. The average annual growth during that entire 10-year period was about 2.2%, whereas in all recoveries post 1980, the average recovery was 3.2%. So there's an example where you had growth, but it was a full percentage point below trend, below what we had done previously. If you go back even further to the end of World War II forward, average recoveries were closer to 4.5%. Yeah. So if that's the potential in a developed economy and you're growing at 2.2, that's depressed growth. We can leave the definition of what happened for those 10 years for another day. But now the point is we've had a technical recession. We may be approaching another technical recession, the first back-to-back recession since 1980. But that aside, we're in a period of depressed growth. We won't recover 2009 levels of output until late this year at the earliest, maybe probably early 2022. And this will persist for not just years, but for perhaps a decade or more. This will be intergenerational in its impact. So that's what I mean by depression. I did an interview the other day, and I said this, could be or was appeared to be worse than the Great Depression. And the person I was interviewing with said, well, hold on, the Great Depression, they recited some statistics since it hasn't been that bad yet. I said, well, you're missing the point. Those figures from the Great Depression took 4 years to play out. We've only been, or in some ways, 10 years, if you go all the way up to 1940, we've only been in this for about a year. So let's, call me next year, the year after, see where things stand. But in my view, we're in a new Great Depression. It will persist. Will have intergenerational effects and will be very, very difficult to get out of. Even periods of growth will be very weak growth.
Yeah, because I can imagine a lot of people think about high unemployment rate, for example, if they think about the Great Depression. And if you look at the unemployment rate, when we last spoke in April, it was sky high, around 15%, and then it went down all the way to around 6.3%. Of course, you can have a whole discussion about the definition of unemployment. In your book, you also describe the labor force participation rate, which has been declining over time. But just purely looking at the unemployment rate, it seems like we are in a much better state now, purely based on that number than we were when we
been dropping steadily since really since the late 1990s, but more steeply since 2008. Fell off a cliff in 2020, but it's dropped over 10 years or so from the high 60s to the low 60s. Now, that doesn't sound like a lot. You're talking about almost 10% of a workforce of 120 million people. So this is 12 million people or so who don't have jobs. But we're not talking just about, early retirees or baby boomers or, teenagers or others. These are basically able-bodied people between the ages of 25 and 54, prime working age. There are over 10 million of them who don't have jobs, but they're not counted as unemployed because they're not looking for jobs. But the point I make is, well, if you're a bartender in a town where every bar is closed, what's the point of looking for a job? Maybe you can move to Phoenix, Arizona and put solar panels together, but that's not very likely. The point is, and that labor force participation rate never gets to 100%. It never gets over 70%. There are good reasons for some people not to have jobs. You could be a student, you could be a homemaker. As I say, there are other reasons. But when it drops that much, you have a large pool. And by the way, I've been speaking of this for a long time. Other analysts have as well. Jay Powell, chairman of the Fed, mentioned it in a speech last week. So it's even beginning to sink in at the Fed a little bit. And he said what we're saying right now, which is if you take the able-bodied Americans who don't have jobs but not looking for them and add them to the unemployed list, that percentage number goes up to about 12 or 15%, and that is a depression level unemployment rate.
Yeah. We met once in New York around 10 years ago when we set up an interview between you and James Turk. That was in 2011. I visited
Right.
New York a few times afterwards, and I really love spending time there, but I haven't been there now in many years. How would you describe the situation there now with all, is there still talk of a lockdown, or are bars opening up again? Could you describe a little bit the setting of New York at the moment?
Yeah, it's more lockdown than not. And this is, by the way, the evidence is overwhelming from many studies, both international and comparing states in the United States, that lockdowns do not work to stop the spread of the virus. They're very good at destroying economies. They don't stop the spread of the virus. We've seen, for example, in the United States, we have 50 states. Well, we never had a national lockdown. It went state by state, governor by governor, in some cases, mayor by mayor. So we have a pretty good, we have a diverse set of experiences. So there are places like California and New York that had extreme lockdowns. You had a place like Florida, which had more of a moderate lockdown. You have a state like South Dakota, which had no lockdown. The governor said, wash your hands, social distance. If you don't want to go out to a restaurant, that's fine, but we're not going to tell you you can't. We'll make it voluntary. The same thing was true around the world. We saw extreme lockdowns in Italy and Spain and France in the first wave in 2020. We had some countries that did moderate lockdowns. I would put Sweden in that category. And some countries that, at least initially, had no lockdowns. And Brazil is an example of that. So we now have the data. We have the 50 states. We have 30 or more countries around the world. And what the data shows clearly is that there is no correlation between lockdown policy and the spread of the disease. Or put in more statistical terms, the lockdown policy has no material impact on the spread of the virus. Whatever policy you pursue, you get pretty much the same results in terms of caseloads and fatalities. I did another interview earlier today. It was a large international audience, a lot of people from Asia, and one question said, New Zealand had a very severe lockdown and the spread of the disease declined. And couldn't the United States learn from New Zealand? I said, no. I said, I don't doubt that you had a lockdown. I know you had a lockdown. I know the disease declined, but it would have declined anyway. And that's really the point. And we see that from a lot of the data. So lockdowns don't help, but they do destroy economies. And that's what we've seen in New York. Now, they say they're easing up, but let's define that. So restaurants can have indoor seating, but only at 25% of capacity. Sports arenas can have fans in the seats, but only at 10% of capacity, and only if you bring a recent test result with you, like a little QR code on your iPhone, etc. That's tantamount to a lockdown. They say they're easing up, but they're not really easing up. The impact on the economy is devastating, and it's not just a question of a business shutting down and then reopening, 6 weeks later, 8 weeks later. A lot of these businesses don't survive. Perhaps half of small businesses are going out of business permanently. Those job losses are not temporary, they're permanent. The owners of, let's say a restaurant or bar, salon, boutique shop, they're closing their doors, breaking their leases, selling their equipment at bargain basement prices, and the workers are never getting their jobs back. Now, eventually those people will get jobs, and perhaps the restaurant owner will move to a different state, move to Florida, and open a new restaurant next year. I'm not saying it's the end of the world, but I'm saying it's the end of millions of small businesses, and that's about half the economy in the U.S. So New York, streets are pretty much abandoned. Murder rate has doubled. Crime in the subway is, people are afraid to walk into the subways. Tax base is eroded. There's graffiti everywhere. Stores are still boarded up, some of them. And the city's depopulating. We, in the United States, when you move, I suppose it's true in other countries around the world, when you move, you can go to the post office and put in a notice of your new address, and that way the post office will forward your mail. So mail coming to the old address will be sent to the new address. Through October, from January to October 2020, there were 300,000 of those mail change addresses filed in New York. It's a public record. Well, there's one per household. So if you assume an average household of 3 people, it could be more or less in a particular case, that's upwards of 1 million people leaving New York. And that was through October. I don't doubt that that number is significantly higher today. It's only a city of 8 million. So you have 1 million people moving out. Cities are the greatest wealth creation, wealth generating agglomerations in the history of civilization, and they're depopulating. So you're destroying the wealth generating potential of those cities. And it's not just New York, it's Chicago, Los Angeles, San Francisco, Portland, Seattle, Baltimore, and elsewhere.
Do you think a city like New York will ever regain its former status? Or do you think it will, from here onwards, only decline?
I think that the decline will continue, partly because of the political leadership. If you don't change the politicians, you should expect more of the same. And a lot of this is irreversible. When a business or an individual moves, you don't move back 6 months later. I mean, you could, I guess, but they're moving. One of the questions you have to ask is, okay, they're leaving New York and the other cities I mentioned. Where are they going? Well, we know they're going to Miami, Austin, Texas, Nashville, Tennessee, Phoenix, Scottsdale, Arizona, and Boise, Idaho, Denver, among other cities. So there's an exodus out of a lot of cities going to either suburbs or exurbs, or in many cases, other cities. Miami's booming.
So there's a vicious feedback loop then for New York, because as people leave and then companies will close, more people will leave, et cetera, et cetera.
Yeah, this is not marginal. This is massive. This is an exodus.
Yeah, and in your book you talk a lot about velocity and monetary velocity, because the first part of the book is about COVID, about the measures, how effective they were, and then the second part of the book is more about the economic consequences of the policies by governments, and especially in the US. Velocity is something that you keep on hammering about. Right now, velocity of M2 has decreased a lot over time, like it half, from a little bit more than 2 to a little bit more than 1, even though the monetary base has doubled, the Fed balance sheet has doubled. We see that the velocity has halved, so the effect, I guess, is neutral. And without velocity, there's no economy. What would be the best way to increase velocity to make people spend again?
Well, the important thing is that velocity is a psychological concept. It's not a monetary concept. The Austrian economists, monetarists, neo-Keynesians all have the view if you print a lot of money, you'll get inflation. That's just not true. Milton Friedman was wrong about that. It's not the money printing that causes inflation. It's the velocity. It's the turnover of money. And the quantity theory of money is just an identity. People say, well, doesn't that prove if velocities not constant, doesn't it prove that quantity theory of money doesn't work? No, I mean it doesn't prove that at all. The quantity theory of money is just a definition. It's like saying A equals A. What it proves is that velocity is not constant. You have to, it's good for thought experiments, but as a guide to policy, it's challenging because you can't. What Milton Friedman did, he held velocity constant and said you could dial up or dial down the money supply, and with a cap on real GDP potential and no desire for inflation. If you want P to be 1, Q to be 3.5%, and you hold velocity constant, you just dial the money supply up or down, and you get maximum real growth with no inflation. That was nirvana. The only problem with that is that velocity is not constant. It was a wrong assumption. And we see that, you mentioned them too, but you can, they're slightly different velocity numbers depending on the money supply, whether you use M0, M1, or M2. But M1, the fall is even steeper. It's gone from about almost 11 to 3. It's been cut by 2/3. So yeah, the Fed has doubled the money supply practically, but with velocity dropping like that, the nominal GDP is up barely. Well, it's not up, and we're still below 2019 output levels. So I remind people, $7 trillion times zero is zero. If you don't have velocity, you don't have an economy. So the question is, how do you get velocity to change? That's psychological. It's based on expectations. You have to get expectations to change. So central banks think that they can do it by holding interest rates at zero. But what message is the central bank sending when interest rates are zero? They're saying that they're worried about deflation. Well, if you're worried about deflation, why should I spend money? I'll just hold on to my money and wait till prices drop and go buy things more cheaply in the future. Or in fact, the real value of cash increases in deflation. So I'll increase my allocation to cash. I'll increase my savings. So the Fed doesn't understand any of this. They barely, they just don't understand monetary policy. They think they're acting in a stimulus way. They're actually impotent because they can't control velocity, and by holding rates at zero, they're sending a signal that they're worried about deflation, so people will save more and spend less. So you're getting exactly the opposite results. Now, how do you change velocity? How do you change expectations? You need to devalue the dollar, but not against the euro or the yen or sterling. I mean, that's all irrelevant. Those cross rates, they trade in a band. I mean, if you're a currency trader, pardon me, if you're a currency trader, you care about it. If you're in the export-import business, you might care about it. But for understanding the value of currencies, the fact that they don't go to zero, they don't go to the moon, they just trade back and forth in a band, but they're all in the same boat. You're never going to have a world where people have completely lost confidence in the dollar, but they're flocking to the euro. That's not going to happen. The euro and the dollar are going to kind of go up and down together with some fluctuation in the cross rate. The only way to devalue the currency and change inflationary expectations is to increase the dollar price of gold.
Yeah, but you can also devalue all currencies against all commodities, right? So the central bankers can come together and jointly decide to produce more money, possibly via the emittance of more SDR, but they can jointly, of course, devalue against everything, not just gold.
Well,
just
they can.
like they're doing right now by extending the balance sheets.
Well, no, they can't. As I just said, increasing the balance sheet doesn't do any good at all. What you have to do is do something else that would cause commodity prices to rise. Now, oils, gold has doubled in the last 5 years. Oil's going up recently. So that trend may be emerging, but it's emerging very slowly. You could accelerate that with a declaration that just gold is $5,000 an ounce, and if the Fed had an emergency meeting, took that vote, said gold's $5,000 an ounce. If you think it's cheap, come and get it. The doors of Fort Knox are open. If you think it's expensive, deliver it to us and we'll pay you for it with using the printing press. And if you use the gold in Fort Knox and the Fed printing press to maintain a market, you're a buyer at say $49.95 and a seller at $50.50, then the price of gold is $5,000 an ounce. And the purpose of doing that would not be to reward gold holders. I mean, it might do that, but that's not the idea. The idea is to change expectations and get the price of everything else to go up, because the world of $5,000 gold is also the world of $400 oil, $100 silver, $20 corn, etc. So this has happened before. That's happened twice. Once in 1933 and once after 1971.
And how much bigger will the Fed balance sheet be after they've completed that revaluation?
Well, it might not be bigger at all, but my point is that the Fed balance sheet doesn't matter. What matters is inflation expectations. And that's based on
people that read the newspaper and see about this then think, okay, we better start spending and start exchanging our money so the velocity goes up. Or because right now we see a lot of news articles about the central banks extending the balance sheets, but it doesn't lead to inflation expectations amongst the consumers. But does a gold revaluation then, does it lead to inflation expectations amongst the common man?
Yeah, absolutely, because people understand gold. And as I say, it has actually happened. This is not theoretical. FDR, Franklin Delano Roosevelt did 1933 on purpose, and it worked brilliantly. Richard Nixon did it by accident, but it also worked. Look at the borderline hyperinflation by the late 1970s. So people will get it. But again, it's not just about gold. It's about expectations. And it's the easiest way to do it. It's the clearest way to do it, because gold isn't good for anything. Gold is a form of money. It's perfect for devaluing the dollar, as I just described. It's not good for anything else. It's not an industrial input like silver. It's not, like they use it to coat space helmets and a few other things, but not much. People talk about jewelry, but jewelry is just wearable wealth. It's just gold you wrap around your neck. But you still treat it as a store of wealth. So gold is the perfect instrument. I mean, I suppose the United States could go out and bid up the price of oil, but why bother if you don't need the oil? Gold is a much easier way to do it.
Yeah, and you call a gold price of $2,500 early 2021 in the book. Of course, the book is already a few months old, but that seems difficult to reach because we only have a few months left. If you would define the first half of this year as early 2021, and later on you expect 14,000 in 2025. That seems very bullish.
Well, not really, because the math is kind of simple. What people lose sight of, say, well, gee, I'll choose $2,000 as a baseline. I mean, that'll happen, by the way, when interest rates turn around. So right now, as we're speaking, interest rates, I'm talking about the yield to maturity on 10-year Treasury notes. So, an intermediate term rate is going up, but that can't persist because it will grind the economy to a halt. So that's going to turn around. It's happened 4 times, by the way, in the last 10 years. You can look at a chart of yield to maturity on 10-year notes, and it has gone up. But every time it went up, it reached a lower peak than the time before. So the previous peaks were kind of 3%, 2%, 1.5%. So now it's at maybe 1.25%, but it'll turn around quickly, and now it's to $15,000 an ounce. That's only a 7% increase. Now it's the same $1,000. If you have an ounce of gold, you made $1,000 in both situations. But those percentage increases, unless when you do the chart logarithmically, that's different. But if those percentage increases become smaller and smaller as the denominator gets larger and larger. So as I say, you've got to get to 3,000 before you get to 14,000. But once it gathers momentum, those subsequent gains, going from 10 to 11 is a 10% increase, going from 14 to 15 is a 7% increase. It keeps getting smaller. So it goes very quickly at the end, even though it starts out slowly, but all the more reason to get gold now so you can participate in those gains.
But many investors have heard these forecasts now for 10 plus years, right? That gold would go to 2,000, 3,000, 5,000. Over the past few months, it's been going down. Even
but that's a really
assets are going up, like crypto, for example.
Yeah, well, crypto is nonsense, but the gold has been going down the past few weeks. Went down yesterday because interest rates are going up, but gold hit $2,070 an ounce last August 8th. So anyone who predicted $2,000 gold was correct.
Yeah, but it was since 2011 that he hadn't reached that level.
Well, that's not true. Well, it bottomed it. Well, 2011, 2015, you had a bear market. 2015 was the bottom, and it's doubled since 2015 and went over $2,000 on August 8th, 2020. So, those are the facts.
Yeah, I know you're
And
not,
maybe
not a big.
if you want to take a 1 week perspective, that's fine. But good luck with that.
No, I mean, I believe in diversified portfolio, and I think gold should be part of that. But I also, what I like about your book is that you, at the end, you also come up with some investment advice or how you believe a portfolio could be structured. But one thing is missing, and I already briefly touched upon it earlier, is Bitcoin or crypto in general. Last time we spoke in April, you called it a massively manipulated instrument and basically fraud. Do you still hold that opinion?
Sure. I mean, look, I'm not saying it can't go up. It could go up to 100,000. I wouldn't rule that out. I did an interview when Bitcoin was 8,000, but it was good. This was in late 2017. It was going up almost like $1,000 a day. So 7,000, 8,000, 9,000. I said it could go to 20,000 and then it will crash. And that's exactly what happened. It went to 20,000. It crashed 80%. All right, now it's back to 50. That's fine. First of all, I have a one-word piece of advice for any Bitcoin holders. It's called Tether. Tether has never accounted for the dollar proceeds, and there's good reason to believe that they take the dollars and invest in Bitcoin. So that makes the Tether Bitcoin relationship the biggest Ponzi in the history of the world. As far as Bitcoin being some kind of reserve currency, that's nonsense, because reserve currencies aren't actually currencies; they are bonds. In other words, people say, the dollar is the leading reserve currency in the world, 60% of global reserves. But it's not as if the People's Bank of China has pallets of $100 bills in the basement of the bank. They have U.S. government securities that are denominated in dollars. So you can't have a reserve currency unless you have a liquid bond market with all the surrounding plumbing of a bond market. You need primary dealers, auctions, when issue trading, futures, options, hedging vehicles, payment systems, and the rule of law, all of which would take at least 10 years to build, maybe 20, if you could. The U.S. has been doing it for 230 years. But the point being, people don't invest in currencies, they invest in securities denominated in the currency. So where's the Bitcoin bond market? Well, the answer is it doesn't exist. There's nothing to invest in. You can buy Bitcoin, but no central
There's a
bank will
lending
do
market,
that.
of course.
Sorry?
There's a lending market for Bitcoin.
Yeah, I could sign out and borrow some Bitcoin, and it's not liquid. There's no rule of law, but good luck with it. But the point is, and it's very small, by the way.
So
But
Elon Musk is a fool then, in your view, for purchasing 1.5 billion through Tesla.
yeah, he's the PT Barnum of our age. But here's the thing about Bitcoin. There will never be a Bitcoin bond market. The reason is, and it shows that the applied mathematicians and developers, Satoshi Nakamoto, if it, assuming that's whoever that was, it's not a team from Raytheon, let's say, they basically said, we hate central banks. This is public. We hate central banks. They print too much money, blah, blah, blah. So they put a cap on Bitcoin. That shows that they know nothing about monetary economics. Bitcoin's capped, I think, around 21 million coins. I could be off a little bit, but that's approximately the number. But the amount of electricity and computing power and mathematical application you have to go through to generate each additional coin gets exponentially greater. So you'll never get to the last coin, but you'll get close. And we're almost there now. We're at about 18 million coins outstanding. And then it stops. Well, if you fix the amount of currency, but the economy continues to grow, I mean, the Bitcoin groupies didn't like central bank printing. Well, central bank printing can be abused and has been abused, but if it's done correctly, the money supply grows in accordance with the economy. And that's why gold is so attractive, because gold is not static. The output is about 1.6% a year of the above ground supply. Population growth is about the same. Real growth can be a little bit higher, but it pretty much, it syncs up pretty well with economic growth. But if you stop Bitcoin here and the economy continues to grow, that's naturally deflationary. I mean, each Bitcoin buys a bigger piece of this economy, and that's why people like Ray Dalio and Paul Jones are running around talking about, $100,000 Bitcoin or more. Why not, right? But the problem is you'll never have a bond market, because why would anybody borrow in a deflationary currency? You have to pay back more than you owe. The point is, it stands in the way of a bond market because borrowers want inflationary currencies, not deflationary currencies. And the result of that is you'll never have a bond market, and therefore it won't serve as a reserve currency. It's just, if you want to gamble, go for it. I mean, I'm not against it. I'm not saying don't. It should be outlawed. I think people should be able to, kind of waste the money any way they like.
A final question, Jim, because I know you're at time trapped as well. SDR, I saw a recent announcement that there might be a new emission of SDRs coming, especially now also with leadership change in the US, and Biden seems more open towards it than Trump. Do you think a new allotment of SDRs coming in this year?
Yeah, it's very likely, and they've said 500 billion for a number, but some people are talking about as much as 2 trillion. I talked about this in well, 4 years ago in chapter 2 of my book, The Road to Ruin. I detailed, I don't, it is an SDR, special drawing right. I call it world money because that's what it is. But I explained how it was coming. So yeah, I said that 4 years ago, and here it is.
Cool. Any other comments from your side?
No, it's interesting times. I guess the point I would make is that depressions are intergenerational in their impact, and we'll be feeling the effects of this for not 30 months or 30 weeks or 30 months, but for 30 years.
Okay, well, let's hope things are not as grim as you describe in the book, and let's hope we can get things back to normal as soon as possible. But thanks so much for your time, Jim, and talk to you again in the future.
Thank you, Paul.